what does an equity investor take away from this? What stocks do you want to buy? Maybe not so much, given what we saw this week.
Yeah, David, it really depends what sort of equity investor you are. What are you looking for? Are you retired and you want to be conservative? Are you younger or have reason to be more aggressive? There are really very different strategies here. So if we look at sort of the more conservative, maybe income oriented, I think you really have to think about having some defensive position, some insurance in the portfolios, because global risks are elevated and they're going to stay elevated. And it isn't just Russia and the Ukraine. It's COVID potentially. It's always other things. And so what's maybe new now is to have some insurance positions that go beyond sort of the energy, the banks, the real estate, the protection against inflation, towards some of those things that will do well if this Russia-Ukraine situation really lasts a long time. What is it hitting? Commodity prices. So you can own not necessarily the commodities, but companies that are going to do well because of those higher prices that are going to persist for a while. For example, a Caterpillar or a Deere, which is going to see a big increase in the demand as more mining happens, right? As more countries go toward demanding food self-sufficiency, for example. So there are a lot of interesting ways to build insurance into portfolios in this kind of environment. But one shouldn't forget the reopening is still happening. And there are some reopening trades one can play if you're careful about the inflation exposure. In a growth portfolio, for example, we just added match as people go out and date more in person. We think that's a good one for folks to be involved with. And then there's the tech side. As we saw, some of the rebound has begun. And we think that's going to continue. But again, some of that is a little bit more on the aggressive side. So it really depends the sort of portfolio. We've owned these things, a lot of them for a very long time. We find it's very important to ride out the volatility in this kind of a market, but you want to make sure you're comfortable doing so.
So now, not to put too fine a point on it, but on the fixed income side, why do I want to invest in bonds right now, given the fact I know rates are going up? And if I do, which of the bonds I want to buy?
So I'd say that for one thing, there's always a place for bonds in portfolios. And certainly this is not the most attractive time to be heavily invested in long duration assets, because I certainly believe that we are going to see a steepening of the yield curve. I know that the markets are anticipating the yield curve actually inverting, which would be positive for long duration bonds eventually. But I would just note that that seems to be assuming that the Fed is going to come in, swoop in and bail the bond market out again, the way it has every single time in the last 14 years since the global financial crisis, when the market has wobbled. So I do think that long duration assets, there will be some interesting plays there because spreads have widened. They may widen a little more. But towards the end of this cycle, certainly a lot of those long duration assets become very interesting again. But right now, I look at floating rate instruments, so I look at the bank loan space. Within high yield, we have seen spreads blow out, and certainly that allows us to go back in and find specific areas and sectors. And here I would actually say that a lot of what Joanne said from a sector perspective applies to fixed income as well, the reopening trades, looking at energy plays, etc. And the last thing I would say is when you do see commodity prices taking off the way they have, one has to remember that within the emerging market space, every country is not a loser. There are countries which actually do well when commodity prices go up and others that do badly. And so even in that area, I would say that there are places where I would say that you can hide. Otherwise, stepping slightly outside my roundhouse, so to speak, I would say definitely it's worth looking at alternatives and from the perspective of real estate and the classic slightly stagflation-y trades, which would be commodities, real estate, places like gold, for example. And certainly, I think that you could probably do with some inflation protection in any way you can find it at this point.
Joanne, what about recession protection? Because we just heard Sonal refer to the flattening yield curve. Some people think it's going to invert, often an indication, depending on which part of the curve you're looking at, of a possible recession. Do you as an equity investor need to be taking into account the possibility of recession in your investments?
Yeah, you want to give it some probability weights. You don't want to necessarily pivot in that direction. We think it's a bit early. We're just seeing such good signs of strength in the U.S. economy. The big concern, obviously, is the war and how it might really affect Europe if it goes on for a long time. But building the portfolio, what we've done for a long time is own stocks that continue to do well even in a recession. There are some consumer staples, for example. Real estate holds up very well. And so you really do have to build that kind of insurance into portfolios as well. And so it does depend on your time horizon and your goals. And, for example, in the growth portfolio, you're still going to be pretty long duration, as Sonal put it. You're going to still own these assets that are going to have a longer time to play through. And so in a recession environment or just a slowing aggregate growth environment, it's important for investors with a long enough horizon to say, well, where can I find growth? What's going to continue to grow even if there's a recession? Look at cloud computing, look at data center expansion. This is still continuing and likely to do so through a recession. Look at software that is used for information technology infrastructure in firms. Those are the sort of companies, by the way, that are well protected from the wage inflation that may very well bedevil profits in more labor intensive industries. And so that's a way to build in that kind of protection into a portfolio as well.
If I could just say one thing that, to go back, and I don't want to beat this to death, but, that inverted yield curve, we need to keep in mind, the Fed owns a quarter of this market. So, it owns a quarter of this market. The yield curve is really not saying as much as perhaps we think it's saying. So that's one thing that I would note. When we look to the yield curve for signs, it is so distorted at this stage that, I would not be able to look at the yield curve. Yeah.
And Sonal, as we were talking about earlier, the nominal rate yield curve, you look at the 210 or, whichever, that's getting very flat. It may very well invert, which kind of makes sense because we have high near-term inflation and much lower projections for inflation 10 years from now. So interest rates near-term should be a lot higher, right, than interest rates longer-term. But if you pull out inflation, right, the real interest rate yield curve is actually pretty healthy looking. And it's the real interest rate yield curve that should be telling us more about real growth projections. And so there isn't as negative a signal coming from there. And I think that's what we're seeing in the strength of consumer, firms hiring, GDP growth expected still to be well above long-term trends this year and next.
I would just add to that. If you look at real yield curves as well, if I look at inflation linkers, that's another market the Fed owns. So, it owns, again, a quarter of that market. So I tend to be a little bit more skeptical about the inflation signals, the duration of inflation expectations. I would just note that as we come to fall, if what we anticipate happens and people have seen 7 to 8% inflation for an extended or protracted period of time, the idea or the risks of a wage price spiral become far more serious. And that means that inflation might hold on for longer than the Fed would like, or indeed any of us would like in the market, because that's not a healthy environment for any stocks or bonds. So
we've made it to the end of this discussion without a lot of discussion about the war. So, Joanne, I'm going to give you the hardest job. Just briefly at the end, the markets seem to be looking past Ukraine right now. Are they premature, or are they onto something?
Well, when we look back at the markets and various wars and disruptions, recessions, pandemics, we do see that investors tend to recognize that wars tend to be temporary disruptions. I think there may be reason to believe that the risks associated with this situation are more elevated, but they're in the tail still. And so I think investors are recognizing that the disruption, even if bad, is likely to be mostly focused on Europe than here in the U.S.